Thank you, Alana. And thank you, teams who got here, Lorian and Vizio. Such great privilege to be on this stage with you guys. While you manage very different, I suppose, portfolios for curates, I think what's critical is obviously you guys manage capsule growth components we're trying to deliver capsule growth for our clients, whether on a more balanced approach or pure equity approach. I think what's really, whilst very different, what's common across both of you guys is your deep hedge fund heritage. It would be great if you guys can both just explain how that hedge fund experience really helps you to manage risk within your guys' equity and balanced portfolios.
We started out as a hedge fund managers, I guess, 16 years ago for the first 4 years. And the mandate is very much absolute return. So we're very cognizant of the net exposure to markets, of your gross exposures, and then drawdowns, whether it be monthly drawdowns, but more importantly, max drawdowns. So you're constantly aware of the markets and protection. Now you use quite a bit of derivatives on that, and throughout time, which sectors, how they correlate, how it works together. So risk management is very important in a hedge fund. And I guess that is sort of the DNA of organization. When we moved into the long-only space, the first fund we went into was flexible, which does enable you to do a lot more. A long-only fully invested fund, I must say, is not quite the same. So for that, we obviously have a benchmark we track. And obviously, you don't want to be too far away from the benchmark, particularly on the downside. Upside's fine. But I think because of that, we monitor factors quite closely on our whole portfolio. Various factors, currency factors are very look through into earnings, currencies, different geographies. If it's a value factor, the large cap factor. So we're very cognizant of that for a long-only fund. But I guess a balanced fund does have a lot more levers to pull, but an equity fund less. But notwithstanding, having been hedge fund managers, or we still are very much hedge fund managers, it does help you on your risk management process.
Thank you. We've summarized it. No, I'll just want to add one or two things. I think for us, from the day one, it's capital preservation. Now, it's easy to say capital preservation, and you can't just say, okay, I'm not going to lose money. But in a hedge fund, you don't want to lose money because you can only make fees or good fees if you show a positive return. The best way to show a positive return is to manage your downside and not have too many losses and big losses. And then it's about compounding. If you're compounding reasonably medium to decent returns year in, year out, because you're not having big losses and big drawdowns, that's how you get good fees, but it's good returns. And compounding with managing your downside, managing your risk is for us what has allowed us to survive and operate hedge funds. And then obviously with a balanced fund, it's the beauty of the balanced fund is we can continue to do that. A balanced fund, we're not bound by the index. We're bound by a tactical allocation, which our master here does very well. And we just have to ensure that we maneuver around that tactical allocation. And that tactical allocation allows us to, again, manage that downside and look to preserve capital on the equities positions as much as possible. And then look to compound returns within the equity, certainly the equities portion of it.
Awesome. Thank you. I suppose it links quite nicely to the next conversation because you started talking about asset allocation. So both mandates allow South African and global positioning. Obviously, by default, is the local, global, and portfolio on the equity side. And obviously, from a balance perspective, with Reg 28 enabling you to now take up to 45% offshore exposure. What guides your asset allocation decision between the local, global for both of you guys? I suppose yours is a little bit more strategic in terms of the process. So it can be more the tactical allocation decision there. But CRP, can you just highlight those decisions?
Sure. I'll go first. Okay. So the framework we use for the balance fund is one of strategic asset allocation. So you've got, and you can consider that as kind of guardrails for ensuring that over time we don't kind of veer too far off our objective, which is the CPI plus 5. Patrice showed the slide earlier of like how the different asset classes make it into the fund and in what proportions. And it's basically two real important factors. One is expected return, and very important in the case of this fund, diversification and correlation, which that Murray mentioned. So, the best example is it works well for me is to use the bond example. Do you buy South African bonds or all global bonds? Obviously, we hold both. And from expected return perspective, you do a valuation, you see whether South African bonds are offering you sufficient risk compensation for the risk associated with South Africa versus what is associated with the US Treasury, which is your risk-free rate, and you decided on the basis of the valuation, you want to buy South African bonds at a certain point. But the next step is to say, well, there is a correlation issue here that could consider, and that is, at times, we would actually be prepared to pay up a little bit of a premium for holding the US Treasury over South African bonds, given the diversification and the protective kind of characteristics that it has. And that is something that's, so it's a good example to in the case of fixed income, and the same framework and kind of approach we take for equities and any other, global versus local asset classes that we consider.
Right. From a equity fund perspective, it's a bit simpler because obviously there's only equities and it aims to be fully invested. So I think on a base case view, roughly about 65% will be the SA equity component and 35% will be offshore listed stocks. That being said, it's not simply a case of just taking the SA portfolio that we have and the global portfolio and putting the two together. There are other factors that you need to take into account in terms of the risk mitigation, the overlap of certain sectors. So if you taking too much factor risk in the sense of too much Chinese exposure, too much resource exposure, etc. So the aim is really to complement with the best ideas. But at the end of the day, what the thing at bottom up fundamental based, we look for stocks where we've got the most upside and really aim to get those ideas in the fund, but roughly on a 65-35 basis.
How much can you tax deallocate between the offshore and local? So everyone knows.
So that could move ±5. Look, we don't try to. No, we're definitely not going to try and call the currency. So it's not a view on where we think the rand's going to go. It's really on the upside that we're seeing in SA equities versus global ideas on that basis.
Maybe to add to that a little bit as well. I mean, we talk about guardrails. So for the international component, to see us deviate from 35 to be less than 25 of that component would be highly unlikely. And obviously we can't go really above 45 because that's the limit. And the other point also to say, in managing the component, offshore is already 40% pure offshore. If you look at the Naspers, the Richemont, the BATS, ABN BETS, we have offshore earnings directly is over 40%. So your portfolio on the SA side already includes a lot of international. So when you put the two together, you don't have that much that is actually pure South Africa. You're probably 25% is what you're actually looking at. So everyone gets excited about South Africa. There's only a little bucket of banks, insurers, some of the domestics. Advotech will do well. But it's quite a small component of the South African index, just as a reminder to a few.
Just for talking about some stock opportunities that you guys are looking at, Junaid. And I know a key component of your guys' process is that once a stock is added, you don't just leave it there. It's not like put it in and forget about it. It's continually reviewing, continually seeing it needs to be staying in the portfolio, whether you need to increase the holding or decrease or sell. Can you give an example of a stock that you've either recently included, upweighted, or sold outright just because of changing investment case?
Sure, it's a good question. So I think, look, to start out with investments, it's not an exact science. So we go in knowing that we're investing, we build our conviction on a set of assumptions, and there will definitely be times where we get that wrong. What we're always doing is reassessing, has the investment case changed? And that's our starting point, as the thesis changed in terms of what we originally invested in. If it's changed fundamentally, we're prepared to cut our losses and walk away. It's never a good thing. It's never an easy thing to do, but there have been times when we've done it. And unfortunately, last year we had some Pick n Pay in our portfolio. When the new CEO was brought in, our investment thesis had changed because he had reversed the strategy of the previous CEO, and we realized there's a lot of risk with that and balance sheet risks with that. And we decided to cut our losses and exit the position. And you could see subsequently they needed a serious rights issue as well as a sell down of the Crown Jewels, the Voxer business. So that was one where we decided to cut our losses. On the flip side, Foschini Group is a position we've had in the fund for quite some time. About a year ago, 18 months ago, when the South African market or retail environment was quite tough, and load shedding was high, retailers were discounting a lot, their earnings were under pressure. We looked at the investment case and our thesis hadn't changed. It was just the cyclical part of the environment had been worse, and we used that as an opportunity to increase our holding during those periods, and that was like around 100 Rand and under 100 Rand. We were adding to the position. Today it's sitting at under 50. So that's one that's worked out well for us where we've had it to the position.
Awesome, thank you. I think that goes straight insight into the process that you guys look at. It's never, as I said, add and forget. I'm going to direct the next question at you guys. I think there's a hell of a lot of balanced fund other markets, and they're very popular ones, as we well know. What has been interesting for me of engaging with you guys for a while is your positionings are often quite different to a lot of the other funds of the market. You were overweight, as an example, to property more recently, and that was a big contributor to returns. What do you think is your differentiator compared to a lot of the other balanced funds out there, and why should guys or our clients in the audience consider you guys?
So for me,
Either.
well, I'm not quite sure what differentiates us. I can only tell you how we do things, and we are very convicted in our holdings. I mean, okay, you can't put certain of our stocks in all the funds, but we obviously look for where it fits best. So certain shares are too small to fit in some of the bigger funds, but they fit very well in a balanced mandate where you can have more conviction and fewer holdings, and you're not bound by a benchmark, and that's important. We are not worried that we obviously consider the index, but it's not our primary focus. We very much bottom up. So as opposed to a long only where you got to be 95% and you got to hold a bit of FirstRand, you got to hold a bit of whatever, or you don't hold, I don't know. In a balanced fund, it's more like a flexible mandate. So is it a differentiator? For us, it is, because we can express our convicted views better in a balanced mandate, in a flexible type format. And that's just where the balanced fund at least get that differentiating factor. And that's why I can say we have decent exposure to, it could be large caps. I mean, we've got, I'm going to mention Momentum, because 2 years ago we bought 6% of the Momentum Group, or 3 years ago maybe now. And it was 15 Rand a share. It's still in the funds now. It was 4% or 3%. It's now 5%. It's almost doubles. So you couldn't really do that in a long only to the same extent because it was 0.5 of the index. So that perhaps is a differentiating factor. Fewer shares, more conviction. We manage a balanced fund like a flexible mandate. Almost a quasi hedge fund, but without the shorts.
Yeah.
Yeah.
What about future fits? Like there's potentially changing regulation down the line where you're allowed to add hedge funds into portfolios. Surely for you guys, and on the balanced fund perspective, could be a competitive advantage, right? Because you've gotten the hedge fund experience already. Yeah. So the potential extra tool in your toolkit, you can't align.
Yeah, the beauty of that is that because I suppose both of us have a track record of our own in veg funds, we can actually, and we did put it in our optimization model, and basically you could comfortably be up to 60% of the balanced fund in a hedge fund. So, we certainly think it's got the characteristics. And while we can't do that because the regulation don't allow, the process and the way we think leans to that anyway. So I think it's extremely beneficial, particularly because a balanced fund, it's a CTR plus 5. Drawdowns are very important. It's about capital preservation and a bit more, and not at any point really trying to shoot out the lights. We just need to continuously make sure that investors can put their whole pot in one spot. So I think hedge funds would be a great addition, but we can manage it given that we think that way and act as much as possible that way.
Then my last question to the Lorien team. Your differentiators, what do you think those are? You had that slide earlier about the fundamentals. You obviously fundamental bottom-up stock because you have a bit of a macro overlay. And you've also come from investment banking, so that nimbleness, that opportunistic overlay. Can you just give a bit more detail into that and how you believe or how that drives your uniqueness?
We all like to think we're unique, but there are a lot of smart people around there and a lot of competitors that are very smart around there. So I think if we look at our team, we're able to compete with anyone on our fundamental bottom-up analysis, whether it's a business assessment, a financial assessment, and evaluation. So we've got a lot of people who've done more than half the investment team, chartered accountant, more than half of them CFAs, but still make lots of mistakes. And so I think we have the ability to compete with everyone out there. The size, I think, as Junaid put up, size-wise, we're credible and we've a large enough team and run a decent amount of assets to be out there and to be involved in everything. The differentiating things is, yes, the one that you mentioned is investment banking backgrounds. That's we spend many years in that on sort of the research. Interesting fact. Patrice I was on the sell side analyst in the 90s, doing industrials and strategy. I used to go and present to Patrice at Liberty. Him, Roy McAlpine, Jamie Ingalls, all of them, and the Peregrine guys. We go back quite a long time. I was on the sell side there. But then we got into the investment banking side, derivatives, capital markets, investment banking, doing capital raises. So I think we have a little bit of special situation when there's a capital raise, like this is quite of a vanilla one boxer which is happening. I mean, we've had 4 or 5 of the team at meetings with management every time, looking at what we're going to do early, and we've already indicated to the CEO how much we'd go in for, and if it's the right price, already told him that. So that when we eventually get the allocations, if it's the right price, we'll get maybe a little bit more. So how we play capital markets is a differentiated event-driven stuff. So we do focus a bit on that. It's a small part of the business, particularly in long-only hedge, it's more. And then I guess the team, we do Africa. We've done Africa from day one. So if you look at the banks, Standard Bank, 50% of the earnings come from the rest of Africa. So our banks guy will probably spend in Nigeria, Kenya, at least once a year, meeting with the CEOs there as well, and he does banks here. So that integration, I think, also does help quite a bit. And then I suppose the same as Visio, we own and managed. I mean, we do. Interesting, we don't allow PA. I don't think I've signed a PA trade in 3 years for anyone in our staff. The money has to go into our funds. Very different to a lot of players. So we're very much aligned. If we bugger up, we're buggering up alongside you. And I think that's very important in life.
Awesome, thanks. Well, thank you guys. I think we've run out of time. Great insights into the balanced fund and the equity space, whether you're wanting capital growth in a more balanced environment, and obviously suitable for Regulation 28 compliant portfolios. And of course, if you want to take more of a higher risk component, there's a lot of attractive valuations in the South African equity markets at the moment, as well as the opportunities in the global. We've got the equity fund available too. But thank you. I'm going to hand over to Solano. Thank you, guys.